the impact on inflationary pressures on my retirement, are there any steps I can take to insulate my portfolio and lump sum, or is it best to hold and weather the inflation storm? Okay, so both those kind of there's two questions there, because inflation is going to have an effect on both the market, obviously, which we've seen already. The negative impact it's had is obviously the stock market's pulled back, but it's been kind of a double whammy with the bond market getting rocked pretty well here, because again, inflation is driving interest rates up, which is driving bond prices down. So right now, just a classic asset allocation portfolio is getting hit across the board. But if we see inflation kind of level out, we should see the bond market start to rebound there. And then if you're talking about the stock market as well, there are different areas to focus for inflationary pressure. At the retirement group, we have a strong focus on value. You might have increased commodities. On the bond side, you might be shorter on the yield curve there. You might have more energy stocks. There are a lot of different ways to look at different sectors to mitigate some of that inflationary pressure. But again, from a long-term standpoint, it will be there, probably through the rest of this year, and we'll have to see what happens beyond that. But ironically, when we look at the, all the last like 10 times we've had inflationary pressure, again, on a long-term basis, the market has performed well. It's usually kind of the immediate short-term period kind of running into a potential recession or high inflation. We see some of those. Now on the lump sum issue, that's a bigger issue. If you're at a company and you're thinking about taking a lump sum and you're thinking about retiring in the next year or two, definitely give us a call. We need to review that with you. There's a lot of companies that our individuals are deciding to leave early because their lump sums are shrinking dramatically. A lot of those are based upon either monthly rates, quarterly rates, or annual rates. So we've seen some of those in the last quarter go up by over 1% on the interest rate scale, which means their lump sums have dropped by 10%. So if you had $1 million lump sum and you were to retire, let's say in June versus July, if you retire in July, it might have cost you $100,000. And the trend is not ending. We're still seeing rates continue to go up. So for a lot of different individuals, if you're thinking about taking a lump sum and not the annuity, you can see that dropping into the point where you're actually working for free if you hang on for another year or so. So it's really important to give us a call to look at that. If you're taking the annuity, it's not going to have an effect on the calculation, but obviously, as things get more and more expensive through time, your annuity value will erode. If you get $3,000 a month, pension right now, it's not going to stretch as far in 5, 10, 15, 20 years. So we can run those side by side in that cash flow analysis as well. So again, it's going to factor through both those, but give us a call. We'll kind of go through your personal situation, take a look at that analysis of your 401k or portfolio, and look at the pension plan as well.